ESG identity is clearly something that does have a really key role to play in corporate resiliency, and it's something we have looked at during our research at State Street in partnership with one of our Harvard Business School academic professors and partners, George Serafine. And we look at it through the perspective of corporate actions, so corporate responses on key ESG issues, and to what extent that leads to corporates being more resilient. And I think it's worth noting that in this process, and I have some slides I'd love to share with everybody so they can get a sense on how this matters. So hopefully you can now see that on the screen. But essentially, I think from a corporate resiliency standpoint, we might expect companies to be rewarded for taking actions that are favorable on ESG criteria. That's in line with their ESG identity. And of course, the actions they take matter, as well as the market perception and the stakeholder perception matters here. So for this research, we took a global view. We wanted to understand to what extent corporate resiliency was influenced by ESG identity through the lens of their actions. It's worth first, I think, defining how we measure resiliency. Resilience in this form is really the ability for a corporate to recover quickly from a difficult situation or withstand a large negative shock. Now, of course, if we look at that negative shocks, we've recently gone through the COVID pandemic, which is arguably one of the biggest and fastest sort of market shocks we've observed through history. It's also, interestingly, from a media perspective, it's been the most heavily covered event over history. So we have a great example with the COVID pandemic to see, well, what did corporates do during this period? What actions did they take according to various ESG criteria? And to what extent were they indeed resilient as a result of their decisions? So we analysed the period from February 20th to March 23rd, and essentially test the hypothesis you see at the bottom here, which is, did firms that took more positive responses to their employees, their other stakeholders, suppliers and customers, were they rewarded by the market in outperformance? Was their share price more resilient to the shock compared to companies that did not or were covered more negatively? So we measure this through the news. We leverage technology, specifically looking at machine learning techniques across hundreds of thousands of digital media articles that cover ESG actions made by corporates globally during this period, and then measure through their stock price to what extent did that get rewarded in resiliency for the firm. So this research, I think ties to a number of interesting topics. It certainly ties very closely to stakeholder theory and the concept of signaling. But we wanted to take a broad perspective. We assess a number of different stakeholders ranging from firm suppliers, employees, and customers. And of course, during this period by COVID, firms had the ability to take good or bad actions, or inactions, I should say, across these criteria. First, if we're focusing on the supply chain management, firms, for example, could have proactively helped alleviate the supply chain and reach deals with suppliers to secure important materials, to avoid shortages and production issues. From an employee perspective, many companies may have taken the decision to support their employees, offer more flexible working setup, paid sick leave, and other support, with the view to trying to build a more productive and maintain high labor productivity, whilst avoiding costly issues with respect to employee turnover. So there's an opportunity for corporates to use their ESG identity and take action with their employees during this time. And third, we look at this through the lens of customers, specifically looking at products and services that companies were able to innovate around. COVID-19 presented a very significant shift in the way consumers were spending and their desirable spending patterns. Companies that could use this time to innovate on their products and services can secure more brand loyalty. So while all of these stakeholder decisions for ESG action are interesting, it's worth also noting that this really only becomes a strategic resource for a corporate when the actions are credible. And what we mean by credible is the actions that corporates take need to involve some degree of investment or significant cost. These can't be very straightforward and easy to implement ideas. And of course, the backdrop of the pandemic by COVID-19 presents a good opportunity for us to test this. It's an expensive time for companies to invest in expanding these relationships and taking action on these important ESG issues. So with that, of course, we had a lot of news covering corporates during the course of the pandemic. we noted that much of that was negative. You'll see some examples on the slide here, which refer to situations around employees not being offered sick leave, issues on production, driven by sort of shortages on supply. We did see a very vast amount of negative news coverage initially around corporate responses. That being said, we did see some nice positive scenarios. Various companies did alleviate their supply chain. They waived various fees for their partners and secured resources where they could to mitigate supply chain issues. There are also examples of looking at extra support and pay for workers and flexibility that, of course, enabled them to tackle human capital and remain flexible. While there were also examples of very rapid product innovations to help secure customer loyalty during what's of course a very challenging time. But the question remains, were corporates rewarded for using their ESG identity and acting on these key ESG issues? So let's set up the framework for how we tested this. We considered corporate responses from 3 different perspectives listed on this slide: human capital, supply chain, and products and services as mentioned. But we also measure the news salience, or the coverage that a particular firm has in the news around COVID-19 and their ESG actions. And we need to control for the size of the company. Large companies get covered more in the news on average, and we want to focus on the degree to which firms are being covered more than normal. And it's also important to control for a number of industry and country fixed effects. Some industries have more of a manual operational procedure process behind their operations, and therefore could be more exposed to this shock than others, while others have more higher spikes in unemployment levels or other key characteristics that also need to be controlled for, so that our analysis focuses purely on the difference driven by companies' decisions or inactions around ESG criteria. Similarly, we do the same for country level fixed effects as well. So to walk through a stylized example, I've just picked 2 firms here from the pharmaceutical industry, Pfizer and Bristol Myers Squibb, purely just as an example. And what you'll see here is a very simple 2x2 grid, which illustrates how we think about this. First, on the horizontal axis at the top, we focus on the sentiment of corporate responses. So we are analyzing using natural language processing. We're screening hundreds of thousands of news articles, in this case using True Value Labs data, to see what was the sentiment in the news of company responses around ESG issues during COVID-19. And you can see that Pfizer, for example, had very positive sentiment. And Pfizer indeed during this time did repurpose a large proportion of its manufacturing to scale up vaccine deployment. It did a lot of work to try and support flexible workers in terms of their setup, which reduced the impact on employee productivity depression that other firms experienced, amongst other areas of improvement. And of course, in contrast, Bristol Myers Squibb in this example did less. They did not discuss reorganizing their operations during this period. On the vertical axis, we then look at the salience of corporate responses, essentially the degree to which the media covered these firms. And Pfizer observed a lot of coverage, Bristol Myers Squibb observed less. And just by this example, we can see that the industry itself, pharmaceuticals, dropped 29% during this period, so they were hit very hard by the pandemic. But we can see that Pfizer, after controlling for all of the effects I've mentioned, the industry, country, and firm fixed effects, outperformed the industry and was rewarded by the market for its actions on its ESG identity, compared to Bristol Myers Squibb that was not. Now, this is just one example. Let's now introduce a broader and much more robust empirical framework to test this. We looked at around 3,000 global firms, which represents nearly $60 trillion in market capitalization, spanning nearly 50 countries. And we basically ran this statistical regression to try and measure the crisis return premium, essentially the degree to which the market rewarded firms for their responses to these key ESG issues. You'll see that our crisis response variable here incorporates all 3 characteristics I've already mentioned: the human capital features, the social capital features, and products and services. And you'll see that we also control for a large number of company-specific, as well as industry and company effects, as mentioned, to isolate the crisis response that's purely due to the firm's ESG actions. So we control for institutional capital flows and holdings, lagged returns, profitability, momentum, dividend yield, market cap, leverage. But we also control for a couple of other important features. For example, EPS forecast revisions. It could be argued that EPS revisions reflect the view that firms are already now starting to be adjusted in their forecast for performance due to COVID-19. So we need to account for this. We also have a feature here called economy, which is another True Value Labs input here, which we use to control for the fact that companies' prospects looking forward could now be different due to the pandemic. And we want to control for this to again isolate the effects due to the crisis response. So very simply, we run this analysis for each firm, and we found some very interesting results, which I show on the slide here. Now, just to sort of help interpret this, we show results for this period for all global firms on the left-hand side. And these numbers represent the crisis premium in annualized percent for firms that did have positive responses from their corporate responses during the pandemic on the ESG issues. And we can see that there was a statistically significant positive premium in the region of 2.2% on average across all the three categories globally. So in other words, the market did reward firms for acting on their ESG identity and taking decisions on these key ESG issues in a very credible way during the pandemic of COVID-19. We then break out the results to firms in the US and firms internationally. And we also break out the results across the three categories: human capital, supply chain, and products and services. And quite intuitively, we see that the results are broadly consistent, slightly stronger in the US. We see supply chain effects matter far more in the US, which is intuitive again, given that the US corporates, I think, realized very heavily how much they relied on China in their supply chain. And of course, the tensions were quite ripe with the US-China trade war. But equally, outside of the US, we found more important results for product and service innovation than we saw in the US. So in essence, again, ESG identity and the actions corporates took on these issues matter, and the market does reward firms for acting on this. Now, the final question we asked for this was, well, to what extent does this vary? Are there factors that could impact this and augment the result? So we ran one final test where we looked at interaction effects, features that could change the response premium. And the way to interpret this here is the first line here represents our base case. This is the global result I showed you just now, with the premium being 2.2%. We then say, well, how does that differ for companies that saw particularly high salience in their responses? In other words, their ESG actions were very, very heavily covered in the media. Well, we can see that the crisis return premium increased. It nearly doubles to 4%. What about industry effects? Where we see very manual processes and high spikes of unemployment, that premium rises further to 5 to 6%. And similarly, for companies that are in countries with a big focus on customer satisfaction, that rises again to 4%. So just to summarize, this shows that corporates were rewarded in the market very significantly for their ESG actions. And it shows really the role of media that underpins this.
Neill, let me ask you this, what has been the role of media? I mean, to what extent does the market pay attention to corporate ESG news?
Yeah, thank you, Elena. Great question. I think the media always has a large role to play, and I think increasingly it is being very heavily used by all sorts of stakeholders to continue to evaluate how companies are adopting ESG principles. And I think ESG identity absolutely feeds in here. We've looked at this as well through our research, and I think there's a number of ways you can look at this. There's certainly not one answer. We looked at it through two perspectives. First, ESG news is absolutely growing. We've looked at this with one of our partners, MKT Media Stats at State Street, that quantify media coverage on different themes. And ESG was one of the most prominent covered themes over the course of recent periods. So it's certainly a topic that's front of mind, and rightfully so. But the question that you've just asked on, well, to what extent does the market react to ES news? That depends. And we thought about that in two ways. First, well, let's have a think about what is the ESG theme that's being covered. And second, we recognize that certain ESG characteristics are more important to firms than others. Some firms, operate in different industries where perhaps environmental factors are more important relative to others that might have more of an importance driven by governance factors. So we look at the concept of materiality, and we lean on the SASB materiality framework to assess to what extent the market responded to news in those categorizations. And actually, I have a couple of slides here that talks to that. And just perhaps starting on the slide here to show you the sample, we looked at more than 100,000 different ESG news articles, which you can see had good representation across all sectors and across a number of different ESG themes. Again, social, human, and natural capital, as well as governance and sustainability leadership, and finally, business model and social innovation. So for this analysis, we look first, to your point, on the whole sample. To what extent does the market respond to global media as a whole? We then focus on the material observations, which you can see drops by more than half. So more than half of the global news articles could be argued are noisy. They're not relevant. They cover topics on ESG matters that are less relevant for the companies given their operating model. So we then run the analysis focusing on the material versus the immaterial news. And then we focus on the breakdown by ESG theme to see, well, to what extent does that vary across the 5 themes listed here. So first, focusing on the market reaction based on all observations and then material observations. We assess this through both negative and positive news, and you'll see the top panel here shows the results for all news articles. And we focus on the average firm stock return in the week before, the day of the media announcement, and the week after. And the results here first show the coefficient, followed by the t-statistic to indicate how statistically significant is this result. So focusing on the first panel here, if we observe negative news on a firm about ESG criteria in the news, we actually don't see a statistically significant reaction across the full sample, which is interesting. Market doesn't respond on average across all of these hundreds of thousands of observations. We do see a statistically significant observation to positive news, and we can see about a 32 basis points adjustment on the day that news article is released, as well as some adjustment the day before, indicating perhaps some leakage of information there. We then say, well, what about if the news is now conditioned based on materiality? The second panel here focuses on the 45,000 or so material articles only. And now we can start to see stronger results. We can see the response double on positive news and start to turn negative on the negative news front. And if we increase the sample size here to encapsulate more and more articles, these results continue on both negative and positive sides to become more and more statistically significant. And to complement this, if we focus on the other half of the articles that were not relevant from a materiality standpoint, we don't see any reaction really of any significance. So again, I think it's worth mentioning that while there is a lot of ESG news for corporates, it needs to be looked through the lens of materiality. We need to focus on what matters for the firm. Finally, if we were to look at this through the lens of different themes, we see a variety of results. We see for social capital and natural capital, very, very strong, significant results and reactions to both negative and positive news. Human capital, we see some evidence on the positive news side, but it's certainly a little bit more mixed. And interestingly, if we were to focus on governance issues, actually, we don't see the market statistically reacting to sustainable leadership and governance-focused news articles. It's clearly not a topic that has quite gained the same media attention as other environmental and other characteristics yet. So it's an area that we're interested in to look at in the future and see whether this starts to manifest and change looking forward.
Neill, we are almost there with our time, but let me ask you one more thing. What should we expect with increasing ESG disclosures?
Yes, absolutely. So disclosures are increasing rapidly. So this is going to become most likely a more important phenomenon. In fact, actually, if I was to toggle forward a little bit, if we were to just plot how ESG disclosures have increased, unsurprisingly, we see really, really strong growth over time. It's grown year on year and will continue to, driven by regulatory incentives as well as firm incentives. Now, the other interesting observation we found is if you think about ESG ratings across different vendors, there's widely documented disagreement, right? You can go to vendor A, B, and C, and D and get quite a different result in some cases for firms. And rating disagreement itself has increased over time. So the question we asked here in relation to ESG disclosures was, does increasing ESG disclosure impact ESG rating disagreement? And quite simply, we found some very compelling evidence to suggest there was. Here we basically split our global sample of firms into terciles, into 3 groups, where they had low ESG disclosure, medium ESG disclosure, and high ESG disclosure. And here we show the mean and median ESG disagreement across rating firms. And we can see a very clear trend. ESG rating disagreement is much higher for firms that had high ESG disclosures. So this is a very interesting result to suggest that, to your point, as we expect to see more and more disclosures in ESG, there is actually more confusion with ESG ratings for companies. So it's perhaps a problem that we will have to face with as we continue to look at ESG data quality and increase disclosure through time. It doesn't necessarily solve this issue. And we also see indeed that disagreement is higher for firms with lower and higher scores. Now, maybe just one final slide in the interest of time, just to try and look at this a bit more robustly. We wanted to see, well, does this vary based on environmental related disclosures, social related disclosures, and governance related disclosures? And we model this for ESG disagreement and for the 3 pillars again. So we do this statistically using a large panel regression framework where we run a regression here, as well as controlling again for many fixed effects to isolate this effect. And you can see that we see across the board statistical strong evidence to suggest that increasing ESG disclosures, both on environmental, social, and governance figures, do drive heightened ESG disagreement. So this is a really interesting topic for the industry to tackle looking forward. And the last point I will make, Elena, is that specifically focusing on the governance factor here, we see strong evidence of this being an effect between firms cross-sectionally. So differences in governance disclosure across firms do indeed relate to wider dispersion in governance disagreement. But it's not something that we've seen as much of a variation in the evolution of time. So I think it's something that corporates can consider as they look to disclose their ESG criteria. This doesn't necessarily always provide more clarity. So a very interesting finding that we look forward to evaluating in the future. But I'll stop there in the interest of time, and I don't know whether there's any final questions that we might have.